Hi everyone, my name is Marshall Condon and welcome to this episode of Finance is the New Black. In this episode, we're going to talk about fixed versus variable. We're also going to talk about using equity to buy more property. First question, Cam, who we got?
Okay, we've got Tess from Dandenong, and she wants to know what's the difference between a fixed and variable loan.
Great question, Tess. Look, it's obviously quite topical at the moment considering where rates are and given we are at all-time lows in terms of our current interest rates. Now, look, to run through each of them, basically a variable loan is a floating loan. So the interest rate may change depending on if the RBA decides to change rates up or down, or what we're seeing at the moment is if your lender decides to change their interest rate as well. So your lenders can change their interest rates outside of the Reserve Bank, and if you have a variable loan, your rate will also change. Now, the pros of a variable loan are flexibility. So with a variable loan, you can pay as much extra as you like without any penalty. You can pay it off the next day without any penalty at all, and you can start, progressively paying into the loan itself, or use added options to decrease your interest like offset accounts and redraw. So it's more flexible for you to be able to pay off your loan quicker. It gives you the ability to refinance during the variable loan without any penalty, but also if you have to sell the property, you can also sell without penalty as well.
What do you mean by penalty?
So what I mean by penalty is exit fees. So back probably a few years ago, most exit fees for variable loans were abolished. So a bank is not allowed to charge you an exit fee for leaving the bank. Now there are government fees because when you leave a bank and go to another bank, it does involve a transfer of the title from one lender to another. So there are associated government fees, which usually equate to about $350. But in terms of the bank fees, they won't charge you anything if you do move. Whereas a fixed rate, in terms of what a fixed rate is, basically with a fixed rate, it is basically what the name says. You can choose to fix the rate in for 1, 2, 3, 4 or 5 years, or even longer if you wanted to. Wouldn't suggest that. Those are usually the rates that end up on a current affair because they're very, very inflexible. So with a fixed rate, they limit how much extra you can pay off during the fixed period, and you cannot get out of the loan in terms of refinance or sell your property without incurring what are called break costs. Now, break costs are like exit fees, like I mentioned before. However, they're a little bit different. So when I was at the bank, they used to call them economic costs because it's essentially the cost that it is incurred by the bank for going out and buying the money at, say, 3 years, if you choose a 3-year fixed loan, and then giving it to you. And if you pay that back and they don't get the interest that they were supposed to get, they'll on-charge that to you. So that can generally be thousands of dollars. So it is important when you're looking at fixed rates, understanding what the downside is so that you know what you're getting into. But the upside though is certainty. So with a fixed rate, for example, if you're fixing for 3 years, your rate isn't going to change for 3 years. So buying your first home and knowing you're going to stay in that property and seeing your structure of a property up front, given its lower interest rate environment, it's not a bad idea looking at a fixed rate. You can fix in at the moment for certainly under 4%, and you've got some certainty around the repayments on that loan, knowing that you're going to pay X amount of dollars per month for that period of fixed time. The good news is you can have both. You don't have to choose one or the other. You can actually take a portion of fixed and a portion of variable so that you can get the upside of both as well as limiting your downside as well. So that's essentially fixed and variable rates, and that's basically how they work and what it means for you in terms of taking them as a loan structure.
So if I've got a fixed rate loan, can I make extra repayments?
So depending on the lender, you certainly can, but it is limited. So for example, some lenders might say, we'll let you pay $10,000 off during the fixed period. Some might say, we'll let you pay another $5,000 per year. It does depend on the lender. So what that means is if your strategy is to progressively start paying your loan down, that may not be a good option because you aren't able to pay as much as you'd like to. So, you might just fix some of it in and have some variable so you can do that on the variable side because you won't get any penalty for paying that off.
So can I have, say, I like that the interest rates are really low at the moment, so
Yep.
I want a 90% fixed loan
Yep.
and 10% variable.
Certainly.
So if I do that, does that mean that I can make as many extra repayments as I like?
So what that would mean is on the variable component, you have complete flexibility. So on the variable component, you can pay that off as quickly as you like without penalty. Now, if you get through that variable component and the 90% is fixed and it's still during the fixed term, then you will then be limited to pay as much off as the bank will let you on the fixed portion. So you'll have the flexibility on the variable side, but not so much on the fixed if you get that far in.
So there is a limit to it.
Certainly. Okay. It's limited by the variable amount essentially. Yep. But good question. Thanks, Tess, for sending it through. Next question.
Okay, it's Vanessa from Kensington, and she wants to purchase another property in the future.
Yep.
And she wants to know how she can use equity to enable that.
Fantastic. Great question. And again, another topical subject. So how equity basically works is equity is essentially the value of the difference between what your property is worth and how much you owe. So for example, if you have a house worth $600,000 and you owe $300,000, you have $300,000 worth of equity. So that's what equity is. Now, in terms of using that to go and buy something else, it applies very, very simply like when you were actually getting the loan out in the first place. Most banks will let you borrow up to 90% of the value of your property, and the difference between how much you're borrowing and how much that is, you can use that equity to go and purchase something else. So in the same scenario, if you had a $600,000 property, you owe $300,000, you can essentially go up to, or borrow up to $540,000. So that additional $240,000 can then be used to buy more property. Now, it does mean it is another loan, so it is a loan to the bank, so you will be paying interest on that. So it is important when you are using equity to reinvest that, again, asset selection, which we touched on previously, is always important. That what you use that money for, you want to ensure that return on that asset is better than the interest of what you're paying back to the bank. So yes, that's essentially how you can use equity, and that's how it can work for you, quite simply. But what we generally recommend is, your situation is always different and has its own quirks. So you need to sit down with a professional, get them to talk through your situation, understand it, and suggest obviously what's best for you in terms of how to get the equity out, and then what you're using that equity for, because that's almost as important as getting the equity out in the first place, is making sure you're making more money than what you're paying the interest on the equity itself. A great question. Thanks for sending it through. We look forward to receiving your questions, and you can post your questions either on our YouTube channel, our Facebook page, or you can private message us on Facebook. Send through your questions and we look forward to answering them.